On the surface, the global economy looks stable, markets are up, inflation has cooled, and central banks assure us that the worst is behind us. But beneath this calm, cracks are forming, cracks deep enough to reshape the financial order in 2026. For decades, money has been propped up by faith, not gold, not productivity, but confidence. And confidence, history tells us, can vanish in an instant. Since 2008, central banks have rewritten the laws of money. Quantitative easing, negative rates, and unlimited liquidity, all designed to save the system. But every rescue created new risks, inflated assets, fragile debt structures, and dependency on central control. The economy is no longer driven by innovation, it's driven by monetary engineering. After the pandemic, central banks pumped more money into existence than ever before. Stocks rose, real estate boomed, and consumers spent like prosperity had returned. But it was not growth, it was injection. A temporary high that hid structural weakness. By 2026, the hangover begins. Global debt has now exceeded $315 trillion, more than 3x global GDP. Governments borrowed to survive each crisis, and now, even minor interest rate hikes threaten their solvency. In 2026, major nations face refinancing waves when massive debt piles must be rolled over at higher rates. A silent avalanche waiting for gravity. Central banks are trapped between two impossible choices: cut rates and risk inflation. Keep rates high and risk defaults. Whichever they choose, the global economy loses. This is not policy anymore, it's trial. For decades, central bank policy has inflated asset prices, stocks, bonds, and housing. The wealthy grew wealthier, while wages stagnated. Now, the middle class is priced out of the system it once powered. The crisis of 2026 will not just be financial, it will be social. Outside the official banking system lies a parallel empire, the shadow banks, managing trillions in unregulated funds. Derivatives, repo markets, and private credit have quietly become the true plumbing of finance. When liquidity dries up, these invisible gears seize first, and when they stop, everything stops. Derivatives, the financial weapons of mass destruction, now exceed $1 quadrillion in notional value. They work flawlessly in calm times, but in volatility, they multiply panic. 2026 could become the year when margin calls cascade faster than regulators can react. Economic pain breeds political extremism. As inflation erodes savings and debt crushes nations, populism will rise. Governments will turn against markets and markets against governments. History repeats. Every financial collapse becomes a political one. All signs point to 2026, a convergence of debt rollover, policy paralysis, and social exhaustion. It's not the end of money, but the end of this version of it. The question is not whether central banks know, it's whether they can still admit it. Few institutions hold such quiet power as central banks. They create money from nothing, steer economies with words, and shape the destiny of nations without ever standing for election. Theirs is the softest kind of power, influence disguised as stability. For centuries, money was metal, heavy, finite, and real. Then came paper, promises backed by gold. But in 1971, the last link snapped. Money became faith itself, and central banks became the new priests of that faith. Quantitative easing transformed modern finance into an act of alchemy. Central banks conjured trillions with keystrokes, buying government debt and corporate assets alike. Markets soared, but real productivity stood still. The illusion of growth was born. Central bankers mastered a new weapon: language. Every statement, pause, and phrase is calculated to move markets without touching money. The Fed put forward guidance, soft landing spells cast to calm investors, but beneath the poetry lies panic. Inflation is not an accident, it's a design. When governments owe too much, they let prices rise, repaying debts with cheaper money. Citizens lose quietly, while balance sheets heal loudly. The crisis of 2026 will reveal how deliberate that silence has been. Debt is the engine of the modern world. Every dollar created is a loan, every loan a future claim on labor. To stop borrowing is to stop growing, and so the system must expand forever. But infinite debt in a finite world cannot last. Central banks claim to act independently, yet their policies move in unison: rate hikes, stimulus, bailouts, synchronized like musicians reading from the same invisible sheet. The 2026 crisis will test whether they conduct or merely react. Behind cooperation lies competition. Every nation seeks a weaker currency for stronger exports. Devaluation becomes the quiet weapon of modern empires, and in 2026, as debt piles grow, the race to the bottom may accelerate into freefall. In the background, a new system is rising. Digital currencies issued directly by central banks, marketed as innovation. They promise speed and security. But beneath the surface lies surveillance and control. Programmable money that can expire, restrict, or direct your spending. The 2026 crisis may become their excuse. Money is not wealth, it's trust. For over a century, central banks have guarded that trust through illusion, coordination, and control. But as faith erodes, their greatest power, belief, fades with it. 2026 may not mark their fall, but their reckoning. The global economy is a vast web woven not from silk or steel, but promises every bond, mortgage, and loan is a strand. Each is connected, stretched, and trembling under invisible tension. In 2026, even one strand snapping could send vibrations through the entire world. After the 2008 crisis, debt became the oxygen of growth. Governments borrowed to stimulate. Corporations borrowed to expand. Consumers borrowed to survive. But like breathing polluted air, this debt-laden growth is unsustainable. Every gasp a little more toxic. Sovereign debt, government borrowing once symbolized stability. But nations now owe more than they can repay. In 2026, several countries will face the unthinkable. Default not by choice, but by mathematics. When the interest costs exceed growth, even empires tremble. Beneath government debt lies a more dangerous layer. Corporate borrowing. Zombie companies, firms that survive only by refinancing, haunt the modern economy. Cheap money kept them alive, but rising rates in 2026 may finally bury them. Households, too, joined the borrowing spree. Mortgages, credit cards, student loans, each promise disguised as progress. The modern dream of prosperity was built on borrowed time, and when interest resets, dreams turn to chains. Derivatives, contracts on contracts have grown into a shadow world worth hundreds of trillions. Few understand them, fewer can control them. They promise stability but breed fragility. A single failure in 2026 could cascade like falling dominoes through this invisible labyrinth. The US dollar remains the world's anchor, but also its greatest risk. Foreign debts are priced in dollars, making global borrowers dependent on American policy. As the dollar strengthens, repayment costs rise, tightening the noose. The very currency that unites the system can also strangle it. From Turkey to Argentina, emerging nations borrowed in foreign currencies to fuel growth. Now, rising rates and falling currencies are crushing them. For them, the 2026 crisis isn't theoretical, it's already here. Their pain will ripple outward like shockwaves through a fragile global system. Behind the scenes, the Bank for International Settlements, the BIS, acts as a quiet overseer. It is the central bank of central banks, the unseen hub of this global web. Its warnings in 2024 were subtle but clear. Debt levels are systemically unsustainable. Few listened. In 2026, everyone will. The danger of 2026 is not one collapse, but a chain reaction. Debt, currency, inflation, and trust, each tied to the next. When the first thread breaks, the tapestry of global finance could unravel in weeks. And in the silence after, we may finally see how fragile it always was. For decades, central banks promised control. Control over inflation, over employment, over growth. But that control was built on illusion. They believed they could print stability. Now, the illusion is dissolving, and the consequences are becoming painfully real. Inflation's first wave hit after the pandemic, a supply shock mixed with monetary flood. But the second wave, expected in 2026, is different. This time, it's structural. Energy transitions, wage demands, and supply fragmentation have permanently raised the price floor. There is no going back. Behind every economy lies energy. Cheap oil powered the 20th century. But in 2026, energy scarcity returns not because reserves vanish but because investment collapsed. Under green transitions and ESG mandates, fossil projects died and renewables aren't ready to fill the gap. Rising fertilizer costs, droughts, and geopolitical disruptions are pushing food prices higher. When food becomes unaffordable, societies destabilize. In 2026, food inflation may ignite the same unrest that toppled regimes in the past. As nations battle inflation, they manipulate currencies to protect exports. A weaker currency means cheaper goods but higher import costs. The 2026 landscape could see a new age of currency wars, echoing the 1930s, when devaluation became a weapon. To stop inflation, central banks raise rates. But higher rates choke growth. To save growth, they must cut rates again, reigniting inflation. This circular trap is the monetary paradox of our time. By 2026, every move may worsen the other problem. Finance depends on faith, not religion, but belief in stability. When depositors doubt banks, currencies, or governments, the system breaks instantly. The 2026 danger is not merely economic but psychological. The loss of trust spreads faster than any virus. Housing once symbolized security. Now it's the epicenter of fragility. As rates rise, mortgages default, property values fall, and the wealth illusion evaporates. Real estate bubbles in the US, Canada, and China could burst simultaneously, turning assets into anchors. For years, technology absorbed capital like a sponge, fueling markets and dreams. But in 2026, tech faces its reckoning. Higher borrowing costs, regulation, and saturation will end the era of exponential growth. The digital frontier has limits, and investors are starting to see them. Every empire faces a storm before its rebirth. 2026 may be that storm, the great financial reckoning. The combination of debt, inflation, distrust, and scarcity could ignite a reset unlike anything in modern memory. But history reminds us, after every storm, a new order always rises. Every economic collapse is a transfer, not a disappearance of wealth. When currencies devalue, those with assets gain power, while those holding cash lose everything. The coming 2026 downturn is no exception. The rich won't be destroyed by crisis, they will be reshaped by it. As currencies weaken, tangible assets, land, energy, commodities rise in importance. Central banks can print money, but they can't print oil, farmland, or copper. The elite understand this. They've been quietly buying real-world assets while the middle class drowns in debt. As trust in fiat erodes, digital alternatives re-emerge. Bitcoin and blockchain-based assets may not replace currencies entirely, but they become hedges against the system itself. In 2026, digital gold is not a rebellion. It's a parallel network of trust. The collapse of regional banks paves the way for consolidation. Fewer institutions mean greater control by the same few hands. By 2026, megabanks could become state partners, merging monetary power with political influence in a way unseen since the early empires. Out of crisis comes control. Central bank digital currencies, once theoretical, now become the default. Programmable money ensures compliance, every transaction monitored, every purchase recorded. In the name of stability, privacy becomes obsolete. Economic collapse reshapes politics faster than revolutions. As inequality widens, populism rises. Old alliances crumble. New powers promise economic salvation. By 2026, the political map of the West could look unrecognizable, drawn not by ideology, but by debt. When governments falter, corporations fill the vacuum. Tech giants, private equity, and sovereign funds already wield power beyond borders. By 2026, their influence may surpass entire nations, creating a world where CEOs hold more leverage than presidents. In every crisis, an underground economy thrives. Offshore finance, black markets, and crypto havens become safe zones for capital in motion. As regulation tightens, wealth learns to move unseen. Power is not destroyed, it goes dark. The greatest danger of 2026 isn't inflation or debt, it's division. A society split between asset owners and debtors cannot sustain peace. When survival replaces aspiration, democracy erodes quietly. The collapse of trust may soon become the collapse of order. Every crisis has its beneficiaries, those who understand the flow before it happens. In 2026, those who adapt, diversify, and think beyond the system will rise. The world is entering an age of resets, and those who study the patterns, the cycles of empire, debt, and money will not just survive. They will inherit the new order. When the crash comes, it won't sound like thunder, it will be quiet. Markets will freeze, headlines will hesitate, and leaders will plead for calm. Then, in that silence, the rebuilding will begin not by design, but by necessity. Every collapse is a reset, and resets always create new rulers. After every monetary failure, a new system replaces the old. In the 1940s, it was the dollar. In the 1970s, the petrodollar. Now, 2026 could bring the next evolution. Digital, programmable, centralized. The question is not if new money comes, but who will control it. Central bank digital currencies are not just about convenience, they're about architecture. Every transaction, every loan, every payment becomes traceable. They promise efficiency, but embed control. By 2026, the financial grid could become a digital panopticon. As private banks weaken, governments step back into the driver's seat. State-directed capitalism once dismissed as outdated returns, but this time it's algorithmic, data-driven, and global. Finance merges with surveillance, and policy becomes predictive. History remembers the ancient solution to unpayable debt, forgiveness from Babylon to Rome. Debt jubilees reset the system by erasing what couldn't be repaid. Some economists now whisper of a modern version, digital write-offs disguised as restructuring. In 2026, what once seemed impossible may become inevitable. As global trade fractures, new alliances emerge. Asia, the Middle East, and Latin America are building parallel systems, trade in local currencies, backed by commodities, not trust. The dollar will still matter, but less absolutely. The world's center of gravity is shifting eastward. For half a century, the world lived in abundance, cheap goods, easy credit, endless energy. But the 2026 cycle ends that era. Scarcity returns as the organizing principle of economics. The next generation will build wealth not through speculation, but through resilience. As trust in central systems fades, decentralized finance gains strength. Peer-to-peer lending, community banking, and blockchain contracts rise from the ashes of failed institutions. It's the rediscovery of financial democracy where power is distributed, not concentrated. Perhaps the greatest change won't be monetary, but mental. People are beginning to question what value truly means. If money is no longer stable, what is wealth? In 2026 and beyond, the answer may shift from possession to purpose. The collapse of 2026 is not the end, it's a beginning. The old system of infinite debt, hidden inflation, and silent control is unsustainable. But from its ruins, a new architecture of value is forming, one rooted in transparency, technology, and trust. The next empire won't be built on land or gold, but on information, integrity, and adaptability.